In the annals of modern business, few stories capture the intoxicating blend of ambition, innovation, and hubris quite like that of WeWork. What began as a simple idea for shared office spaces rapidly transformed into a global phenomenon, captivating investors and promising to redefine the future of work. At its peak, this vision propelled the company to an astonishing $47 billion valuation, an almost unimaginable figure for a business essentially subleasing real estate. It represented not just offices, but a lifestyle, a community, a revolution. But beneath the polished surfaces and aspirational branding lay a complex reality, poised to unravel with dramatic consequences for its founders, its investors, and the entire startup ecosystem. The story began in 2010 when Adam Neumann and Miguel McKelvey founded WeWork in New York City. Their first venture, Green Desk, an eco-friendly co-working space, had laid the groundwork. WeWork emerged from a desire to scale that concept, focusing on community and vibrant design rather than just affordable desks. Neumann, with his charismatic personality and grand pronouncements, quickly became the public face, articulating a vision far beyond mere office rentals. McKelvey, with his architectural background, brought the aesthetic and practical design elements to life, crafting spaces that were both functional and aspirational, designed to foster collaboration and a sense of belonging among members. From its inception, WeWork aimed to be more than just a landlord. Neumann envisioned a global community, a network of entrepreneurs and creatives connected by shared spaces and a shared ethos. The company invested heavily in creating visually appealing, amenity-rich environments, featuring everything from kombucha on tap to meditation rooms. This focus on community as a service was central to its appeal, distinguishing it from traditional serviced office providers. It wasn't just about renting a desk, it was about joining a movement, a lifestyle that promised innovation, networking, and a vibrant work-life balance. This cultural emphasis fueled its early growth and captivated a generation of startups and freelancers. WeWork's expansion was breathtakingly fast. Propelled by eager venture capital and a seemingly insatiable demand for flexible workspaces, the company rapidly opened locations across major cities worldwide. From a handful of offices in New York, it quickly scaled to hundreds of locations across dozens of countries, becoming a ubiquitous presence in urban centers. This aggressive growth strategy was fueled by the belief that scale was paramount, that capturing market share quickly would solidify its dominance. The brand became synonymous with the modern startup aesthetic, attracting businesses of all sizes, from nascent ventures to established corporations seeking flexible solutions and a vibrant culture for their employees. A pivotal moment in WeWork's journey came with the intervention of Masayoshi Son, CEO of SoftBank. Son, known for his audacious bets on technology companies, saw WeWork as more than a real estate play. He viewed it as a world-changing technology platform. His belief in Adam Neumann's vision was absolute, leading SoftBank and its Vision Fund to inject billions of dollars into the company, providing the fuel for its blistering expansion. Son's unwavering support and immense financial backing were instrumental in inflating WeWork's valuation to unprecedented levels, making it one of the most highly anticipated IPOs in recent memory. He believed in Neumann's ability to digitize real estate and build a global network. Adam Neumann was undoubtedly the driving force behind WeWork. His outsized personality, boundless charisma, and evangelical belief in the company's mission were legendary. He possessed an extraordinary ability to articulate a grand vision, inspiring employees, enticing investors, and attracting a dedicated following. Neumann's unconventional leadership style, however, often blurred the lines between his personal life and corporate governance. His pronouncements about elevating the world's consciousness and transforming WeWork into a capitalist kibbutz created a narrative that transcended typical business objectives, making the company seem like a movement rather than just a commercial enterprise, which was both its strength and eventual weakness. Under Neumann's leadership, WeWork began to diversify far beyond its core co-working business. The company launched a range of ambitious, often ill-defined, ventures under the We umbrella. These included WeLive, a co-living concept, WeGrow, an experimental private school, and even acquisitions like a surf pool company. This expansive strategy aimed to create an entire ecosystem where members could live, work, and learn within WeWork's orbit. While these ventures demonstrated Neumann's boundless ambition, they also raised questions about focus, profitability, and the core identity of the company. Each new initiative stretched resources and diverted attention, further complicating the company's already intricate financial structure. Fueled by SoftBank's massive capital injections and the general exuberance of the pre-IPO tech market, WeWork's private valuation soared to extraordinary heights. What began as a modest startup quickly became one of the world's most valuable privately held companies. Investors were buying into the narrative of a tech company disrupting a traditional industry, rather than a real estate company with high operating costs. The promise of scale and network effects, often cited in tech valuations, seemed to apply to WeWork, even though its business model was inherently tethered to physical assets. This meteoric rise created immense pressure for a blockbuster public offering, seen as the ultimate validation of its innovative model. Despite the dazzling valuation, early concerns began to surface. Analysts questioned WeWork's path to profitability, highlighting the significant losses it incurred despite its rapid growth. The company's unique blend of real estate, hospitality, and technology often confused investors and obscured its underlying financial health. Critics pointed to the capital-intensive nature of its business, requiring constant investment in new locations, and the long-term lease commitments that formed the bedrock of its liabilities. The narrative of being a tech company started to feel increasingly strained, as its operations fundamentally relied on physical spaces and traditional landlord-tenant relationships, raising questions about its true innovation and scalability. Beyond financial concerns, questions about corporate governance began to mount. Adam Neumann's control over the company was absolute, reinforced by supervoting shares that gave him a decisive majority. Instances of self-dealing emerged, including Neumann leasing properties he owned back to WeWork, and trademarking the We brand, then selling the rights to the company for a substantial fee. These arrangements created clear conflicts of interest, blurring the lines between the founder's personal wealth and the company's financial interests. Such practices, while not always illegal, raised serious red flags for institutional investors and underscored a lack of independent oversight at the highest levels of the organization. In August 2019, WeWork officially filed its S-1 prospectus with the U.S. Securities and Exchange Commission, a mandatory step for any company seeking to go public. This document, intended to provide transparency to potential investors, instead opened the floodgates of scrutiny. The S-1 revealed a staggering array of financial complexities, corporate governance red flags, and personal indulgences that had previously been hidden from public view. What was meant to be a triumphant declaration of readiness for the public markets became a highly anticipated, and ultimately damning, exposé of the company's inner workings, sparking widespread alarm among financial analysts and the media. A deeper dive into the S-1 revealed a company bleeding cash. WeWork disclosed massive losses, totaling billions of dollars, with no clear path to profitability despite its rapid expansion. The prospectus also detailed a highly unusual governance structure that granted Adam Neumann immense power, even if he were to be removed from his position. Investors found bizarre terminology, such as the company's mission to elevate the world's consciousness, juxtaposed with complex financial engineering. The document painted a picture of a company more focused on growth at any cost and founder enrichment than on sound financial management, shaking the confidence of even its most ardent supporters. The S-1 also brought to light details about Adam Neumann's personal behavior and lavish lifestyle, which further eroded investor trust. Reports emerged of private jet travel, extravagant parties, and a general disregard for corporate norms. His penchant for purchasing buildings and then leasing them back to WeWork, or taking out enormous personal loans collateralized by company stock, created a perception of self-enrichment at the company's expense. These revelations, combined with anecdotes of his erratic management style and drug use, cast a shadow over his leadership, making him appear less like a visionary and more like a liability in the eyes of the public markets. The widespread negative publicity surrounding the S-1 filing and Neumann's conduct swiftly changed investor sentiment. What was once seen as a groundbreaking tech company with limitless potential began to be viewed as an overvalued real estate play with serious governance flaws. Analysts, initially eager to embrace the We narrative, turned skeptical, publicly questioning the company's valuation and business model. The market's appetite for high-growth and profitable startups was waning, and WeWork became a prime example of a company whose story could no longer mask its underlying financial weaknesses. The enthusiasm that had propelled its valuation began to evaporate, replaced by caution and concern. As public scrutiny intensified, WeWork's projected IPO valuation began a precipitous decline. Initial estimates of a $47 billion valuation quickly fell to $20 billion, then to below $15 billion, and continued to drop. The stark reality of the company's financial position, coupled with questions about its leadership, spooked potential investors. It became clear that the public markets would not tolerate the same level of risk and unconventional governance that private investors like SoftBank had. The company was forced to repeatedly delay its initial public offering, a clear sign that the market was not willing to accept the valuation or the terms that had made it so attractive privately. Ultimately, the pressure became too great. In September 2019, WeWork announced it was formally withdrawing its IPO filing. This decision marked a dramatic pivot from the company's ambitious plans and signaled the end of its seemingly unstoppable ascent. The withdrawal was a massive blow to WeWork's prestige, its financial standing, and the morale of its employees. It was a humbling admission that the company, as structured and led, was not ready for the public markets. The dream of a blockbuster IPO, which had driven so much of its growth and valuation, collapsed, leaving a void of uncertainty and a pressing need for fundamental change within the organization. With the IPO withdrawn and investor confidence shattered, the board of directors, pushed by SoftBank, moved to oust Adam Neumann as CEO. In late September 2019, just weeks after the IPO fiasco, Neumann stepped down, relinquishing his control over the company he founded. His departure was a monumental moment, signaling a dramatic shift in power and direction. Despite the circumstances, Neumann secured a substantial exit package, including a nearly $1.7 billion payout from SoftBank for his shares and a credit line. This controversial golden parachute further fueled public outrage, highlighting the stark contrast between his personal gain and the financial turmoil gripping the company. Following Neumann's ousting, SoftBank was forced to step in with an emergency bailout package totaling over $9.5 billion. This infusion was critical to prevent WeWork's collapse, but it significantly increased SoftBank's stake and its financial exposure to the struggling company. The bailout effectively valued WeWork at a mere $8 billion, a stunning 83% drop from its peak valuation. SoftBank, once the company's biggest champion, found itself in the unenviable position of having to salvage its investment, taking control and installing new leadership to attempt a turnaround. The episode became a major financial misstep for SoftBank and its Vision Fund, eroding investor trust in their investment strategy. In the aftermath, WeWork embarked on a painful and prolonged restructuring. The company installed new leadership, including Sundeep Mathrani as CEO, to steer it away from its past excesses. This involved widespread layoffs, divesting non-core businesses like WeLive and WeGrow, and renegotiating expensive leases to stem the bleeding. The focus shifted from aggressive growth to profitability and operational efficiency. In October 2021, WeWork eventually went public through a SPAC merger, achieving a significantly reduced valuation but finally reaching the public markets, albeit through a less glamorous route than initially envisioned. It was a stark reminder of the long and arduous road to recovery. The WeWork saga offers a potent case study in the perils of unchecked ambition and flawed corporate governance. It underscored the critical importance of a clear business model, robust financial oversight, and a balanced board of directors to rein in a powerful founder. The story also highlighted the dangers of market exuberance, where investors, particularly in private markets, can become captivated by a charismatic narrative and overlook fundamental financial red flags. WeWork served as a cautionary tale, prompting a more skeptical approach to growth at all costs strategies and forcing a re-evaluation of how much power should be concentrated in the hands of a single individual, no matter how visionary. Today, WeWork continues to operate, albeit as a shadow of its former, aspirational self. It successfully emerged from Chapter 11 bankruptcy in June 2024, shedding billions in debt and renegotiating leases. While it still offers flexible workspaces globally, the grand vision of elevating the world's consciousness has been replaced by a more pragmatic focus on financial stability. Its story remains a powerful reminder of how quickly immense wealth and perceived value can evaporate when fundamental business principles are neglected. WeWork's journey from a $47 billion valuation to bankruptcy and rebirth stands as one of the most compelling and dramatic narratives in recent corporate history, a complex legacy of innovation, ambition, and ultimate reckoning.